Over the past few months, there have been here today, gone tomorrow tariffs, market volatility, and increasing geopolitical friction. And we're still only halfway through 2025. Today, we sit down with Aidan Yao, Senior Investment Strategist Asia for Amundi, a leading European asset manager, to ask him what the rest of the year and beyond might look like and where investors could possibly see safe harbor. It is a very turbulent time for the markets, and this uncertainty just seems to continue day by day. So how does Amundi see the rest of the year going in terms of the equity markets? I'm definitely not asking for a crystal ball,
No.
but I am asking for maybe, and I used this word earlier, a temperature, an indication. So how's it going to go?
So I think you really have to separate the near-term outlook from the medium-term outlook. The near-term outlook, it's looking quite encouraging. Obviously, tariffs, trade war have been a plaguing factor for the markets over the last couple of months. We have seen a first trade deal come through between US and the UK. We're actually seeing substantial progress in bilateral trade talks between China and the US. So it does appear that the tension is fading off. We don't know how long it's going to last, but at the minute, it does appear the tail risk is being reduced. At the same time, you could argue that the US economy, based on hard data, it's still looking fairly solid, and the markets are expecting the Fed to provide more support later in the year. So putting these things together, the near-term trajectory does look quite encouraging for risky assets, including US equity. I guess the medium-term uncertainties still remain, so we have to find our way to navigate forward. So I think the cloud remains in place. We're not out of the woods clearly. I guess if Trump just wants China to buy more soybeans, oil and gas, and control better fentanyl, then those are easy concessions to be made by Beijing. So we could actually see further reduction of tariffs. Remember that of that 30%, 20% is linked to fentanyl. However, if the negotiations turn to structural issues, China's currency regimes, China's industrial policies, subsidies for manufacturing, minimum wage, VAT, you name it. These things, I don't think they are up for negotiation from Beijing's perspective. They are related to economic sovereignties, and Beijing want to dictate the progress in its own terms at its own pace. So if these things become a contentious point in the negotiation, you could imagine that negotiations get nowhere.
What is the investment strategy for unpredictable times?
In terms of the recommendations we have for our investors, basically three things. Number one, stay cautious. Number two, stay selective. And number three, stay balanced. Let me just explain a little bit on every of these 3 points. Stay cautious. Clearly, we're facing epic uncertainties with respect to US policies, with respect to the global economy. So it certainly pays to be cautious and prudent. Add some protections and hedges in your portfolio. Make sure that it can stand the upcoming storms. Getting into some safe havens. Gold has been performing well. Euro has been performing well. Japanese Swiss francs have done pretty well during turbulent time. Number two, stay selective. We know that there are risks that they exist in terms of trade, in terms of tariffs, in terms of protectionism. So which economies are more export sensitive.
Yes,
which economies are more geared towards the US final demand. So stay, relatively speaking, clear of those markets. And finally, stay balanced. The world portfolio has become, over the last decade or so, very lopsided in terms of overweighting US dollar assets, predicated on this expectation that US exceptionalism is going to continue indefinitely.
Exactly.
Now, clearly, we're seeing the dynamic change of the drivers of that US exceptionalism. So stay more balanced, tone down your US dollar overweight, and get into non-dollar markets for better risk reward.
There is a key word to keep in mind here: exceptionalism. American exceptionalism is a belief that the United States is a unique nation with a commitment to upholding democracy, liberty, and self-governance. Yao says that there were fundamentally 3 things driving the U.S. exceptionalism over the past few years, namely a strong U.S. economy, support of U.S. policies, and exceptional innovation. All of this, of course, has changed. Yao explains that it was years of American exceptionalism that caused the US dollar overweight portfolios in the first place. Ever since the new administration took over, there has been a notable reversal out by investors, with money more recently flowing into the likes of Asian currencies such as the Taiwanese dollar. And if this reversal of American exceptionalism continues to be the new normal, Yao says that this means that what were considered traditional safe harbors, the greenback, US Treasuries, will no longer be. He also says that because the US dollar and US Treasuries are so gigantic, it is impossible to make a one-for-one swap. Instead, what we are looking at now is possibly a new world order, moving from what he calls a unipolar world to a multipolar world, where investors now put together a basket of potential alternatives. However, it is impossible to exclude exposure to the US entirely, hence why it is fair to ask this question. Is the US headed for a recession?
So recession, particularly for the US, is not our baseline case, although the chance of a recession has clearly increased. So I guess there's a number of things that we have to consider. Number one, clearly the fading of attention between US and China is helping to dial down the recession odds. Secondly, that we do think the Fed eventually will come around to support the economy. We still have a 3 rate cuts priced in for second half of this year. And fundamentally, U.S. economy, especially in the private sector, household balance sheet, business balance sheet are still very healthy. So sure, there could always be shocks to the economy that drives a temporary slowdown. But if you have reasonably good balance sheet and not a lot of imbalances entrenched in the economy, you can avoid very severe sort of downturns.
So how are Amundi's economists expecting emerging economies, bringing it back to where we are now, right? Like Malaysia fare for the second half of the year?
So I think the emerging market really face sort of dichotomy, right? The external arena is very risky, very unclear. You have no idea where the landing zone is for US tariffs. But the domestic situation is a lot more certain. And for a lot of economies, even with this external shock, you have a more insulated economy and you have a domestic policy room, a monetary fiscal policy easing that can provide an offset to that external shock. Those are the economies that we like. So for emerging market, I mentioned that 3 things: stay cautious, stay balanced, and stay selective. Selectivity is really key. You know what kind of economies are more export-oriented, they are more geared towards the US demand, and you know which economies, particularly in this part of the world, are more insulated with bigger domestic activity.
Yeah, it's very clear. It's not a guessing game.
Exactly. So through that kind of a rigorous economic analysis, you can sort of navigate and underweigh the more vulnerable ones and embrace the more solid domestic driven ones.